Hi, this is James Eng of Old Capital, and today we're going to be going through a January 2022 sort of multifamily market update and current financing update in terms of bridge, Fannie, Freddie, and recourse bank loans. We just got back from the National Multifamily Housing Conference over in Orlando and thought I'd just give you an update on what we're seeing out there in the market. My background started sort of born and raised in Houston, went to school in Texas at Austin, UT Austin, and started on the underwriting side at G Capital and have been focused more on multifamily loans the last 5, 6 years at Old Capital, doing about 1.1 billion in multifamily loans, and then also investing in properties as a limited partner. Done about 25 properties, or in about 25 properties right now throughout DFW and Austin, Texas. So let's just jump right in. So National Multifamily Housing Conference. This was over in Orlando. We just got back. So Paul Peoples over at Old Capital and I were there with 5,000-6,000 of our closest multifamily friends. So on the left hand side, this is how it sort of starts in the morning with some coffee, and then by the time the afternoon, you're by the pool, and you've never seen as many guys in suits around the pool. And then at night, it sort of turns into a nightclub over there at these hotels. So it was a good time talking with these folks, brokers, owners, lenders, everybody is there. So let's just dive into sort of what we're seeing in the market right now, just sort of from a macro perspective, and then jump into how that's impacting financing for multifamily and the market in general. So unemployment is down, significantly from over the last year and a half since COVID started. I mean, I think anybody who wants a job out there can get one right now. So that is sort of rippling its way through the cycle and through the market right now. So unemployment's really low, and that's actually fueled a lot of the demand, right? So a lot of people who maybe didn't have jobs or were afraid to go out and get jobs or move or do anything, middle of last year, they decided, hey, I've lived with this roommate for a long time, or I've doubled up, tripled up, and now I'm going to go out there and move to go get that new position in a new city. I graduated last year, but I stayed home, and now I'm going out and getting my apartment. So the demand for apartments has increased significantly. Absorption along with that has increased, and that's driven a lot of what we're going to see in the next couple slides. And that leads straight into the rent growth, right? So you can see some of these top markets, Phoenix, Austin, Atlanta, since 2020 when COVID hit, up 25% in rents. Some of the laggards are, sort of 5 to 10%, and that's really on the coast. And then on the right-hand side, you can see, yep, apartment rents have come up significantly. So, it's up 10, 20, 30%, depending on the market. But then single family sort of pricing has gone up. And so that's impacted the mortgage payment for a lot of these guys. So here I pulled up, all right, what median home prices have done. So, sort of when COVID hit, it was around 275. And then now it's probably closer to 350. So close to 15% increase in pricing for your for your single family homes out there. And so, when you look across the board, across the nation, and you're thinking about, all right, where's the rent growth happening? The dark colored states are really where population growth has increased. And you can see that corresponds with the rent growth, right? So we're looking at these green dots, whether it's Phoenix or Austin or Florida, that's where the population growth is moving. So that's accelerated during COVID, but then also everyone's predicting that to continue. And then in terms of deal volume, sales volume, I mean, you've seen some charts that I put out before in terms of what, how much has traded. And this chart I thought was interesting. Like, a lot of the data hasn't come in yet for Q4 2021, but just from everybody that you talk to in the industry, I think it's going to be a blowout quarter for how much multifamily traded. And then this really just shows not only the deal volume, but the pricing, right? So the apartment and industrial markets are just red hot with, in terms of pricing and the number of deals happening right now. And so this chart sort of goes back a little bit further than we normally do, but showing where 10-year treasury is in comparison to multifamily cap rates. And this trend line just continues to go down on the multifamily cap rates. And then, since COVID, the 10-year treasury has popped up a little bit. So that margin that, a lot of listing brokers like to show has decreased. And we're watching that very carefully. All right, so here's a chart sort of year over year. I would say, about January of 2021, the interest rates, 10-year treasury was probably around 1%, and now it's closer to 175, 180 right now. So it's up 75 to 100 basis points from where we were a year ago. And this is probably the more interesting chart, is around LIBOR, SOFR. This is the index that all your floating rate products are based off of. And so almost everyone's predicting 2 to 3 rate hikes by the Fed this year. And that is going to directly impact LIBOR and SOFR. And so you can see the bigger blue dots are sort of what the Fed governors are predicting, or the members of the Fed are predicting. So pretty much a year from now, you might be at 1%. And then 2 years from now, you're going to be 1.5 to 2%. And so think about that as you go out and take floating rate debt, sort of where you want to buy your rate cap. Do you want to buy it at 1%? Do you want to buy it at 2% over the next couple of years to protect yourself from this thing rising too quickly on you? All right. So, at this conference in last week, it was really around, all right, am I a buyer? Am I a seller? Right now in today's market, and pretty much everybody we talked to seemed to be like a net buyer. So let's talk about sort of pros and cons for buying right now. Pros are, the rents are up, right? So your rent roll is probably, there's a ton of loss to lease in it. You haven't been able to turn over your entire rent roll, so rents are up 10 to 20%. There's a lot of equity. So whether it's syndicated equity that you're going out raising from limited partners, or private equity where you're getting like a family office to write 90% of the equity check, there's a lot of equity out there. And I've never seen so many $50 million funds being raised right now. So a lot of equity, a lot of debt. Bridge lenders are still, they're sort of reset their bucket. So they've got plenty of money out there. And then, multifamily in terms of rents are cheaper than single family going out and buying. So even like the Class A, where, usually you're saying, well, how much more can you raise the rents on the Class A? Because, you could just go rent a house at that point. The single family rentals has increased quickly, but then also the pricing. In terms of cons out there for buyers, I mean, there's limited inventory. There's not going to be as much on the market. A lot of stuff got pulled forward for Q3, Q4 of last year, and it's record pricing. So every month, it seems like pricing is increasing. And so that's going to make it difficult sometimes for you as a buyer to be comfortable, number one, but then also for it to appraise, when you go out and get your financing. Agency debt is still at low leverage, right? So they're still using 125 debt service. Minimum 125 on most deals. And so it makes it difficult to get more than 60% on a lot of these deals because the pricing has moved quicker than the rents. And so that's going to drive, if let's say you do put down 30, 40%, your cash on cash is going to be pretty low. But what most people are doing are bridge loans right now. And so, that's going to be on a floating rate basis. So that sort of leads into number 5, which is, interest rates could rise on the short term. And so you might start with a rate, say of 3.5 or 4%. And now if it raises 25 basis points every quarter, then all of a sudden you could be at 5.5% on your rate. And then you bought at a 4% cap, so that you could be upside down on your leverage there. And then, rents are going up, but then insurance and real estate taxes can increase. There's no cap on insurance and real estate taxes. And so that could increase pretty quickly on you and impact your NOI. So from buying perspective, I mean, there's a lot of good things out there, but then also just be cognizant of some of the risk out there from the buying side. And, for every buyer, there's got to be a seller. So let's look at some of the pros and cons of selling right now. There's a ton of buyers. That's number one. So everywhere we look, there was a buyer, and there's a ton of buyer demand out there to move into multi. Whether that's guys moving from the coast into sort of southeast markets, or it's guys moving from office or retail into multifamily. There's a ton of buyer demand. Pricing is accelerating quickly. So if you thought you had a good price last year, the price is even better this year. So it's still increasing the pricing. A lot of times you might have bought a deal, let's say 12 months ago or 24 months ago, and you're ready to take some money off the table, or you might have held the deal for 3 or 4 years and COVID was tough, and now the freeze was tough on you here in Texas. And so now it's, you've got your occupancy up, you've got, the place is full and your collections are good. Now it's time to take some money off the table and sort of hit your business plan, because maybe you haven't been able to distribute as much cash flow. So take some money off the table. Treasuries are up. So, treasuries were probably 1% a year ago. Now it's 175. So that will help your yield maintenance if you have a fixed rate loan. And then also, I've seen some deals where essentially the developer, they get the CO and they're like, all right, I'm ready to sell this deal. And, they don't even want to do the lease up on the deal before taking it out to market. And so you can shift some of the execution risk as a seller and get, you might get half the upside that you would if it was a fully stabilized deal. So some of the cons of selling right now, I mean, you sell the deal that you were making 5, 6, 7% on, and now you go to cash and you get 0% in your bank account. Inflation's running 5%, 6%, 7% right now. So you have a place for the cash to go to, number one. And pricing could keep going, right? So just the amount of demand, the amount of investors looking at multifamily, if you hold it for another year, you might get another 5, 10, 15% on your pricing. So that's another con. And then if, as a general partner, like you don't really make any money unless you're out there doing deals, buying, selling deals. So you're gonna have to reinvest into this market. And so making a decision on, all right, if I go out and buy a deal right now and it's at a high price and I got to do a bridge loan to get the leverage to make syndicators happy or make your limited partners happy, does that put me at risk in the future? So just thinking about some of the cons there if you do end up selling. All right, so that was sort of your market update. Let's jump into the financing side of the market and what we're seeing. So this is just sort of your recourse bank loan, Freddie SBL, Freddie conventional, Fannie, and non-recourse. We're going to hit each one of these and go through a couple of case studies. So on the agency side, just at a high level, they did both agencies did 70 billion in 2021, and then they have a cap of 78 billion for 2022. So they got about 8 billion more, a little bit more focus on affordability, but both of them have plenty of money to lend. So, all right, but let's start with on the right-hand side, non-recourse bridge. So bridge lenders really, they got pretty full in December of 2021, and they started moving minimums, right? So in order to do less volume, they just said, hey guys, we're not gonna do your $5 million deal. We're not gonna do your $10 million deal. We'll do your $20 million deal. So they started focusing on larger deals. Interest rates stayed about the same, 3.5 to 4.25. And now that the year has sort of reset a lot of that in terms of minimums, they're still probably trying to push for $10 million minimums. I would say that 5 to 10 million is probably the trickiest right now in terms of bridge lending. Everything over 10 million has a pretty healthy number of bridge lenders going after it. But 3.5 to 4 is sort of your spread over SOFR right now on most non-recourse bridges. Plenty of bridge lenders in the market. We talked to 3 or 4 new ones over at the conference, and a lot of them are still going after the same type of BNC properties, and they would love to do even A properties. All right, so non-recourse bridge. Some of them are still doing LIBOR, but most of them are transitioning over to SOFR. And as we said, if it's a larger deal, 20, 30 million, you're probably in that 335, I would say, is the minimum. 350, 360 is probably standard. And then if you're under 10 million, you might be in the fours on your rate right now. But here's an example of, I just used $30 million, and you used to maybe get 60, 70% leverage on Fannie and Freddie, but where pricing is in sort of your major markets right now, you're probably only 50%, honestly, on Fannie and Freddie right now. And then non-recourse bridge, you can get 75, 80% on most of these deals. So a lot of people end up using bridge on these acquisitions. For bridge, I mean, for us to size it, you really need just sort of your standard T12 rent roll OM, CapEx budget, some pro forma cash flows, and then this last, three things. The track record of the sponsor is going to be important. Pro forma of rents, and then also sell comps to support the purchase price. So those are the things that we're going to need when we go out and shop this loan with lenders. Here's an example of a deal we closed in the fourth quarter, 91 units over in Fort Worth. We were able to get 80% of purchase, 100% of rehab, 3+1+1, 5 years IO. This was under 10 million. So we're right at about 4% on the rate, and then it had a 1% prepay. So that's what I would say pretty standard for sort of 5 to 10 million. If you get above 10 million, that's where the pricing comes down to maybe 375. In terms of interest rate cap, you saw the forward curve earlier. A lot of the cost is really hitting in that year 3. So if you go out and buy, let's say, a 2% strike right here, for the first 2 years, it's 41,000. And then, that third year costs you $60,000. A lot of the cost is coming in that. So if you can, if you have plenty of money to buy the 3 years, you go ahead and buy the 3 years. If you're a little tight on cash flow right now, you might buy a 2-year and then relook at it in maybe a year and a half and decide, okay, am I going to sell this deal, or am I going to refinance this deal, and make a decision from there. All right, so that was non-recourse bridge. That's where we see probably 75% of the acquisition volume going right now. But a lot of the, let's say, Fannie and Freddie on smaller deals, and then potentially even, refinances, we're seeing people go to Fannie and Freddie. So Fannie Mae is essentially mostly fixed rate. They started doing floating rate loans above 15 million. So that's also an option. The rate has moved up significantly with the 10-year treasury. So 10-year treasury is probably up, I would say 175 to 100 basis points. And the corresponding fixed rates have moved up sort of year over year. So last year, you're probably 325, and now you're 375 to 4 on your fixed rates for Fannie. This is a deal, Nova Park over in Garland, 198 units that we closed back in the fourth quarter of 2021. So it's a floating rate loan. We were able to get, we were right at about 65% leverage on the deal, 4 years IO. And the difference really on this one was, instead of taking, let's say, a floating rate loan and maybe getting 75% leverage at 3.5% plus SOFR and having a shorter term, the buyer decided to take a little bit less risk, bring a little bit more equity, and did, SOFR plus 254, and then have a 10-year term. So they had the flexibility with a little bit more equity to get a lower rate, and then have a little bit more time on the loan term. Freddie Mac conventional starts at 7.5 million. So this is in that 7.5 to 15. If you're still wanting to do floating rate, Freddie Mac conventional works pretty well. I would say their process is a little bit slower. So this is going to take probably a full 60 days to do, as every deal's got to go into Freddie for approval. But rates, you can see here, I mean, fixed rates are about the same, 375 to 4 on the fixed rates. Floating would probably be 270 to 275 over SOFR right now. So this is a Freddie Mac deal. This sort of fell in between that 7.5 and 15 million that Fannie usually does. So we went with a Freddie, non-recourse floating. And this one ended up being about 287 over SOFR, 70% LTV, 5 years IO with a 1% prepay. So that was one that we closed sort of middle of last year. And so if you go down one more notch, a little bit smaller deals, sort of $1 million to $7.5 million, you're in that Freddie Mac SBL range. And this is non-recourse still, and it is based off the 10-year treasury as well. So they move a little bit slower. It's not directly when you sign the loan application. they're going to look for, when you sign the loan application, they actually hold the rate right there. So that is good. So you don't have to buy an interest rate cap or anything like that. It's going to be a fixed rate on these Freddie Mac SBL loans. They have had more of a focus on local sponsors. So, buying a deal in your neck of the woods, and then also having some experience, typically wanting 2 years of experience in 3 properties. These are taking about 60 days to do right now. The rates are still probably 360 to 380, depending on your loan term. Majority of deals that we're seeing right now, most people are going with, let's say, a 7-year step down. You can do yield maintenance, but it's a little bit lower rate, but your prepay at the end is going to be a little bit higher. This was a deal we closed fourth quarter of last year. It was a busy fourth quarter of last year, as you can tell. It fit sort of in that around $7-8 million purchase price, and then $5.5 million loan. So it's about 74% LTV, so good leverage. 7-year loan term, 2 years IO, and mid threes. I think it was like 3.5 to 360 on rate, and then step down prepay. So for these smaller deals, even if you go down 5-10%, if you're buying a deal, let's say with 1 or 2 partners, this makes sense. Just to do it through Freddie SBL allows you to sort of lock in a low fixed rate as we see interest rates move up, and then do a step down prepay, so you can take care of your interest rate risk as well. And then in the fourth quarter, we got some recourse bank loans done. Number one, because of timing. So they're probably 30 to 45 days to close. You get a fixed interest rate, so no interest rate cap needed. You're probably 375 to 4.5, and then your prepayments lower. Legal fees are lower. You will have to put up some deposits probably at the bank, and these deals can get done quicker. I would say most people are doing them sort of from 1 to 10 million, and depending on the leverage, depending on the debt service coverage, you might actually be able to, especially in that $1 to $5 million range, get some of these deals done, with a partial recourse, right? So instead of personally signing for the whole thing, you could do a partial recourse where you're not responsible for, you might be responsible for 10, 20% of the deficit if there was a deficit. So just to take a little bit more risk off the table. Here's a snapshot of probably about half the deals that I worked on last year. As you can see, a mix of Fannie Mae, Freddie Mac, non-recourse bridge, Freddie SBL, all throughout last year. And I think it's going to be more of the same this year in terms of what we're going to see, but probably acquisitions are probably going to be a little bit more heavy on the non-recourse bridge side. And then, what Old Capital does, we are a mortgage broker. So we work with you, the investor, sort of figure out if Fannie, Freddie, bridge, CMBS, HUD, construction, all those things sort of work, or what the best option is for you. And then also, help you, educate you at the beginning of the deal, during the deal, and then even after the deal, whether it's asset management support or highlighting you on, the podcast or conference or Facebook group, things like that. So in terms of next step, definitely subscribe to the channel to get updates. We're going to start doing some what's the deals and things like that as deals come out. And then if you need, let's say, a loan term sheet or looking at a deal, send me an email with T12 rent roll OM and the whisper price, and then we can get that sized up for you. And then if you need help reviewing a deal, let's say you're looking at a deal from a limited partners perspective, and you want me to review the investment package from the GP, happy to do that as well. And then usually the first thing that I'm going to ask you to do is complete like a personal financial statement. And then we can set up, whether it's, buying, selling, refinancing your next deal, we can talk through next steps for that. And then at Old Capital, we're actually always interested in hiring more directors or people who are looking to get into multifamily and sort of learn the business. You can send me an email with your resume and we can take it from there. And thanks for joining, and hope you have a great new year.